main macroeconomic feature of the week is likely to be the latest autumn statement from the Chancellor of the Exchequer, who is still Jeremy Hunt, on Wednesday the 22nd of November, although there's a fair chance that much of this will be leaked or trailed in advance of his speech to Parliament and the nation. Other than that, the macro could be relatively quiet, with Chinese 1- and 5-year interest rate settings on the 20th, US durable consumer goods orders on the 22nd, and a couple of European sentiment indicators, Germany's IFO and Belgium's Koopsinthetiek on the 24th, the other likely features. Those European surveys could be particularly interesting, given ongoing fears that the EU could be sliding toward a downturn after the 0.1% quarter-on-quarter drop in GDP between July and September. Remember that another quarter of that, well, that would mean 2 consecutive declines, and that's the technical definition of a recession. Just by way of a reminder, the IFO reading improved in October to 86.9, while the Koop sagged lower to minus 16.8. On the company front, 8 members of the FTSE 100 are due to release a trading update or results or host an analyst meeting, while a lengthy list of mid and small caps are expected to do the same. Names which may be worthy of further research include the following, although there's always a chance that some of these dates prove subject to a last-minute change. Diploma, Compass and Big Yellow on Monday the 20th. Telecom Plus, Workspace, Cranswick, Avon Protection on the 21st, when International Consolidated Airlines will also host a Capital Markets Day. Sage, Kingfisher, Britvic, Speedy Hire, TT Electronics, Grainger, AO World, Breeden and Rotork on the 22nd. Intertek Johnson Matthey, Virgin Money UK, Mighty, First Group Volex, AB Dynamics and Coates on the 23rd, and Mothercare and Hornby on Friday the 24th. But the company which could just cause the biggest fuss in the week ahead, however, is Severn Trent. The utility, which provides water and water treatment services to around 8 million people and 4.5 million households across the Midlands of England, as well as a stretch of East Wales, is scheduled to release the first half results for the year on Wednesday the 22nd of November. Shares in the FTSE 100 firm traded in a wide range over the past 12 months, but the net result has been a modest decline. The public controversy over sewer flooding, pollution, stormwater overflows has dampened sentiment towards water utilities, especially as the regulator, Ofwat, called for £140 million in bill reductions from service providers and has launched investigations at a sensitive time for the industry, which has sent its proposals for the AMP regulatory cycle into Ofwat. Now, that AMP8 cycle will run from 2025 to 2030, and utilities must provide pricing and capital investment assumptions, as well as plans for environmental and cutting water and supply interruptions. Now, we must say here, Severn Trent did well in the 2022 regulatory review and was not one of the 7 utilities that were deemed to be lagging their and Ofwat's targets in October 2023 either, and in fact the firm's on track to receive additional income, not pay penalties, for its performance relative to targets. Note also that Severn Trent has already tapped shareholders for £1 billion back in September to fund its AMP8 proposal, so it's pretty well prepared. A bigger cloud, therefore, as far as Severn Trent's share price is concerned, may have been interest rate increases to the Bank of England. Utilities such as Severn Trent offer some degree of inflation protection for investors, as their revenues and dividends can be index linked, but they usually are not seen as a source of capital growth. As such, markets tend to treat utilities as bond proxies, since fixed income is about yield and income rather than capital return. The higher bond yields go, the more attractive alternative fixed income looks relative to utility equities, and vice versa, as this chart shows. The UK 10-year gilt yield is inverted on the right-hand side, although we must acknowledge, looking at this trend anyway, the past is no guarantee, of course, for future stock market trends or returns. Now, Severn Trent submitted its AMP8 proposal to the regulator in October and hosted an analyst meeting shortly afterwards to outline it. So the focus of these interim results is likely to be actually how the numbers stack up relative to the company's guidance for the full year, given alongside last May's annual results. The key points here from Chief Executive Liv Garfield were an increase in sales of between 7.5% and 10% from the regulated water and wastewater business, higher operating costs thanks to upward cost pressures from pay, energy, and more investment on how to stem flooding, higher profits from property sales and a largely flat contribution from outcome delivery incentives of around £50 million, as Severn Trent outperforms regulatory requirements. Watch out also for any change in customer bad debts. A lower interest bill compared to last year's £363 million, although the lack of rate cuts in Bank of England could be a challenge here. A big drop in the tax rate thanks to tax breaks for higher investment. And that combination overall underpins analysts' forecasts for an increase in stated pre-tax profit for the whole fiscal year to March 2024 to £238 million against last year's £168 million. Note that for a benchmark in the first half last year, Severn Trent made £105 million pre-tax. Another big number to note is capital expenditure. That's peaked above 800 million as Severn Trent got ready for the end of AMP6 and came in at 737 million even last year. However, the budget for this year lies in a range of 850 million to $1 billion as the FTSE 100 firm readies for the end of AMP7 and the start of AMP8. Finally, lower capex can mean higher cash flow, and it's cash flow which funds the dividend. Higher capex could of course pressure that, but there's no sign of that as yet. That's, again, the dividend is always a key point for any utility. Under AMP7, the goal is to raise the dividend in line with the CPIH inflation measure. Management has guided to a full-year dividend of 116.84p against 106.82p last year, and the first half payment a year ago was 42.73p, so it seems logical to expect a small increase on that this time around. I hope that you and your families are all in good spirits and good health. Thank you for watching, and I look forward to seeing you again next time.